Hello guys, welcome to Steady with Collins, your number one YouTube channel for industrial engineering content. Today, our video will be focusing on IE 455, and that is costing and break-even analysis. What is break-even analysis? Break-even analysis is the study of cost volume of production profit relationship, and we normally abbreviate this cost volume of production profit as CVP. Break-even helps to determine the point at which the total revenue equals the total cost. That is where there is no profit and no loss, and that is break-even analysis. Profits mainly depends on three factors. That is the amount of input. So amount of input is the resources or the effort put into production. Then cost of production too. Cost of production is the total expenses incurred to produce goods or service. We have sale revenue. So sale revenue is the income earned from selling and service. So these are the three main factors that profits depends on. Then we move on to cost of production. So cost of production is the summation or the addition of variable costs and the fixed costs. Now, what is variable cost and fixed cost? So fixed costs are assumed to be constant at all levels of output. That is fixed cost. And an example of fixed cost is expenditure on permanent labor and overheads. And another example is the cost of rent. Before you can set up a business or a factory, you need to rent a place or buy a land. So the money that you use to purchase a land or rent an apartment or a building is considered to be fixed cost because it does not change and it remains constant. Whether you want to increase your production or reduce, it's constant at all levels. And labor hours, let's say salary, you have employed 5 people to work for you, and at the end of the month you have a fixed amount that you are going to pay them. So their salary does not depend on the amount of production. That is why labor cost is a fixed cost, right? Then we have overhead too. So you might have several machineries in your company and they might need oiling or greasing because they are mechanical components. They will need some form of servicing, and we consider that as overhead, and they are fixed, right? We move on to variable cost. So what is variable cost? So it's the opposite of fixed cost. So with variable costs, they increase when the production or volume of production increase. Variable costs increase with the increase of output of production. If you want to produce more, you would have to buy more materials. Simple as. We move on to other relevant terminologies, and other relevant terminologies are revenue. So what is revenue? Revenue is the money realized from the sales of goods produced or purchased. Revenue is a critical measure of business performance, and it represents the inflow of what funds. Revenue reflects sales performance. Then we have contribution margin. So contribution margin per unit equals selling price minus total variable cost per unit, and which includes production, selling, and administrative charges. So basically, this is the mathematical expression for contribution margin, and that is the selling price minus what total variable cost per unit. Okay, the total contribution margin shows the overall ability of the business to cover what fixed costs and to achieve profits, and that is contribution margin. So contribution margin helps in pricing decisions, okay, and understand how efficiently costs are managed. So therefore, if you understand contribution margin, you will be able to analyze profitability and determine the break-even point. Total contribution margin is the difference between the total revenue and the total variable cost for all units sold. Now, one of the techniques to study the total cost, total revenue, and output relationship is known as the break-even analysis. Break-even analysis is the study of cost, volume of production, and profit relationship. It is an analysis to study the point where neither profit nor loss is. Okay, so this point is known as the break-even point. Break-even point is determined as the point where total income from sales is equal to the total expenses. Break-even is used to give answers to questions such as what is the minimum level of sales required to ensure the company will not experience loss. So this type of question means that this helps business to set sales targets to avoid losses. Okay, and another question is break-even point helps or answers the question how much can sales be decreased and the company company will continue to be profitable. So this provides insight into how much room there is to handle potential decline in sales. So break-even analysis is based on categorizing production costs between those which are variable costs, and we know variable costs, and those that are fixed, and we know fixed costs too as well. So examples of fixed costs is administrative costs, rent, overhead, and depreciation. As I said, an example of variable costs are production wages, raw materials, and seller's commission. Seller's commission is a variable cost because you pay a seller based on how much they are able to sell. So the more they sell, the more they are commissioned. Okay, so the total variable and fixed costs are compared with sale revenue in order to determine the level of sales volume, sales value, or production at which the business makes neither profit nor loss. So importance of break-even analysis. So break-even analysis helps to address the following issues. What volume of sales will be necessary to cover a reasonable return on capital investment? Computing cost and revenue for all possible volumes of output. And break-even analysis also helps the company to know that this will be my position if I sell 2,000 products. This will be my position if I sell 5,000 products. And I would get profit after selling 5,000 products. I'll start to get profit. So they compute cost and revenues for all possible volumes of output. So you know that after setting up my business, after selling 20 products, this is my standing. So then to find the price of an article to give the desired product. And break-even analysis also helps in terms of pricing. As I said, for contribution margin. Contribution margin helps in pricing decisions and also understanding how efficiently costs are managed. So, and the last one is to determine the variable cost per unit.